one of my friends actually said that I have a green wall, right? So why don't I have like green screen effects? So I'm gonna give that a try, and if it looks really weird, right, maybe I'll do something else. Who knows? But let's see how that looks. Hopefully it looks good. I'm gonna do the rest of the video like this. If I get a positive reception, I'll just keep going. Hi everyone. So I know that investing is really difficult for people, and sometimes most of us don't even know where to start. All right, since this video is all about investing, I want to be very clear, right? I have a disclaimer in my description, but a disclaimer here never hurts either. I'm not a financial advisor. I'm not your financial advisor, so be sure to do your own research. Now, investing is a little bit overwhelming. I think the best way to go about it is to figure out a common goal. The common goal that everyone has when it comes to investing is retirement. Right? For the most part, all of us are going to retire, or the majority of us are going to retire. Right? At some point, we have to stop working. Retirement is a goal that we can all agree on and figure out the best investment approach to that. This video is really about the lazy and simple way of investing, because I know not all of you want to dedicate your entire time to investing. And even if you're first starting out, that's not what you want to do, right? You have to start somewhere. Now, the first thing I want to talk about is mutual funds. Now, mutual funds is something that I spoke about previously. On the highest level of understanding, a mutual fund allows you to own a lot of investment securities without actually having to own them directly. Instead of buying a single stock of Apple and a single stock of Google, you can buy all the tech companies in the US stock market for a much more affordable price. And that's the whole point of having a mutual fund. Now, depending on the type of mutual fund you buy, they could be free or they could cost money to buy. Don't confuse this with the fact that they do have ongoing fees. If you buy an individual stock, you don't have to pay an ongoing fee. Nowadays, you don't have to pay anything actually. You just buy it and you hold on to it. When you buy a mutual fund, you have to pay a yearly fee associated with it. It doesn't come directly out of your account, rather it comes out of the investment itself. So you don't really see it, but you have some sort of metric to determine how high that fee is. The lower the fee, the better, right? That's not always true across the board, but generally speaking, you want to go for a low fee mutual fund. Now, why do mutual funds charge you a fee? Well, because it's sort of like the lazy way of investing. It allows someone else in the finance industry to pick the investment securities for you. Right? So they can decide, hey, today I want to buy some Apple, today I want to sell some Facebook, and so on. So you don't have to make any of those big decisions. Instead, someone else does it for you, and they just manage your portfolio for you in the form of a mutual fund. So I want to talk about a subset of mutual funds, right? Because not all mutual funds are created equal, and some of them actually might not even help you that much. But the subset geared toward retirement will help. So let's talk about age-based mutual funds. Age-based mutual funds will go by many names, and you see some of them listed here. The finance industry created this set of mutual funds specifically for the goal of retirement. You can easily find them when you're scrolling down investments in your 401k, for example, because most of these mutual funds or age-based funds will have a year next to it, and that year signifies the year that you plan to retire, right? Or think of it like this: the year that you plan to hit 67, right, which is the full retirement age, if you plan to wait until then. Otherwise, 62, when you can first claim Social Security. The Social Security Administration can change those retirement years whenever they feel like it and whenever they need to. So just keep in mind that sometime around 60 to 70 is probably where you want to retire for most of us. Of course, unless you're thinking of retiring earlier, then that's a different conversation altogether. So one thing to keep in mind when it comes to picking that specific age-based fund, you don't have to pick the exact year you plan to retire. Just ballpark it. Right? If it's 2 or 3 years away, pick the one that's closest. Usually they're 5-year, 10-year increments, so it's not too far apart. Usually, if you have a 401k or a 403b, you'll see these funds in those accounts, right? You're allowed to invest in them and pick from them, and you just have to look for which one's the best for you. And most people can just put all of their 401k into those funds. At the beginning, when you're further away from retirement, they're more aggressive, more risky, right? Which means higher returns, generally speaking. And then towards retirement or closer to the retirement year that's specified on the fund, you're going to have less risky assets. It's going to be more conservative so that you don't lose money when a recession happens. Rather, you keep what you have as much as possible. And the goal of this is to make as much money as possible early, and then to retain that wealth as much as possible in your later years closer to retirement. Some of these age-based funds actually require a minimum investment. right? Some of them could be $1,000, some of them could be $3,000. Just look for that and see if you fit the requirement. And some of them don't require a minimum investment. Let's talk about some of the pros of an age-based fund, right? There's a couple, and the biggest one is that you get to be lazy about it, right? It's simple. You basically put all your money into these funds and you don't have to think about it. You don't have to pick your own investments and you don't have to really plan around it. The whole point is a fund manager will handle it for you. It's great for beginners, and especially if you don't want to think too much about investing. A lot of us might not want to do investing full time. A lot of us might not even want to do part time. We just want to know, hey, I'm going to put my money away and I want it to grow over time so that I have enough by retirement, which is a completely fine approach. Right? At the end of the day, it's your money and you can grow it however you wish. Just make sure that you do grow it. And these funds are really designed for retirement, right? I wouldn't say use it for anything else. Really, it's for retirement. And the goal of it is to set and forget it, right? Maybe you check in on it every year, maybe you check in every so often, every quarter, but you're not supposed to be constantly looking at it, seeing how it does. And like any mutual fund, it's diversified, so it means low risk, but the risk is not zero. There's no such thing as a zero risk investment. So just keep that in mind. It's not a golden ticket. You still have to do some work to find a good age-based fund that fits your needs. But it's going to be significantly less work than if you picked your own investments altogether. Now, the biggest con is that you don't get to maximize your returns. If you want to maximize your returns, you're going to have to do more work. You're going to have to dedicate more of your time to researching which funds or which investment would make you the most money over that period of time and for your goals. It might not be worth it for retirement, but it might be worth it for other investment goals, right? Like buying a house, right? Your time horizon is much shorter. How are you thinking about saving for that? But since this is about retirement, we're going to focus on that and say an age-based fund is just fine. One other thing to keep in mind is that fees tend to be higher just because a fund manager is doing everything for you just to plan for your retirement when it comes to growing that money. So the fees tend to be higher than other mutual funds. You can assemble your own set of mutual funds for retirement and the fees will be lower. So it really depends on how much time you want to contribute toward it. Not all fees are created equal, right? Some of them have higher fees, some of them have lower returns, right? Some of them have higher returns. So it's really about figuring out which one works for you. And if it doesn't work for you, do your research. Make sure you compare one age-based fund to another age-based fund and pick the best one for you. Now here's the big question. Should you have an age-based fund? You gotta ask yourself, do some introspection. Are you willing to put in the time and effort to plan for your retirement when it comes to growing the money? If the answer is no, an age-based fund is just fine. Even if you did want to build your own retirement funds, this is still a great place to start. If you don't want to think about it, or if you're just starting out, have the experts handle it for you, at least for the time being. And then once you get a good handle of how investments work, how retirement works, then you can sort of diversify, pick your own funds yourself, and then go from there. It all comes down to if you want to put in the additional time and effort to researching about investments or not. Right? If you feel like this is just fine, then go for it. It's much better than letting your money just sitting in the bank and doing nothing, especially when it comes to planning for retirement. I want to walk through an example of how to look and research at one of these age-based funds, but just keep in mind that I'm not going to catch everything that may be relevant to you. And I'm not saying I'm recommending this mutual fund. It's just one that I happen to be going through. So feel free to check out your own at your own pace. And all right, the first thing first, just Google the name of the fund and you'll find where it's coming from and you'll find a whole bunch of information. So for example, I'm gonna look at this Vanguard fund and you'll see that, hey, you can see information on sites like Morningstar, Yahoo Finance, even Vanguard themselves. So there's a lot of places to get information, but I'm just gonna click on one of them and go from there. All right, just make sure that the ticker symbol, which is right there, and the name of the fund matches what you're seeing in your investments. Either it's in your 401k, your 403b, or maybe your IRA, right? Just make sure that the names align so you're looking at the right thing. Now, the first thing we'll look at is the fee, right? What is the fee? Right? Some of them charge you to buy the mutual fund, some of them don't. That's a discussion for another day. But the thing that's a yearly fee is the expense ratio, right? This is the percentage of the asset they charge every year. Whatever percent this is, and you multiply it by how much money you have invested, that's how much they charge. Now, the next thing we want to look at is minimum investment, right? If you don't have enough money to invest right now, don't worry about it. There's always other age-based funds that don't have a minimum investment. But in this case, this one just so happens to have a minimum investment. Returns is another place that we can look at, right? You can see it grow over time. You want a mutual fund, especially if you're young, for it to be growing a lot, right, in the past couple of years. If you are a little bit closer to retirement age, then maybe you want it to be more steady, right? You don't want it to be so volatile. You want to make sure that you have money when it comes to retirement and it doesn't dip into the floor when the recession hits. And the last thing here is that it's a mutual fund. So someone else is controlling your investments for you and they're picking what goes into this age-based fund. So the best thing to do is do your own due diligence, figure out what's going into this fund, see how, what sectors and what industries it's invested in, and get a good idea about how they pick your investments, so that that you're at the very least, you can trust the people that's doing the lifting for you, right? If you figure out that, hey, they're making all the wrong investment choices, maybe you don't invest in those funds. Right? Like I mentioned before, not all funds are created equal, and you need to do your own research when it comes to that. But it's much less work than picking your own individual investments. All right, well, I hope that was helpful. I hope that if you're not invested and you have a lot of money, or if you have a 401k or 403b that's just sitting around and you don't know what to do with it, maybe consider an age-based fund, especially when it comes to retirement, because it does get the job done. And if you're curious about more videos when it comes to investments, let me know. Be sure to like, subscribe, and comment. And I'll see you around for the next one.